What does disregarded entity mean for LLCs? Have you ever wondered what a disregarded entity means for limited liability companies? This concept can be a bit confusing, but understanding it is essential for anyone involved in a single-member limited liability company. Let's break it down in simple terms. A disregarded entity refers to a single-member limited liability company that the Internal Revenue Service treats differently for tax purposes. While the limited liability company is a separate legal entity, the Internal Revenue Service does not recognize it as a separate taxpayer. This means that the income, expenses, deductions, and credits of the limited liability company are reported directly on the owner's personal tax return. Typically, owners use Schedule C for business income or Schedule E for rental income when filing their taxes. This setup allows for a straightforward tax process, avoiding the need for a separate business tax return. It also helps prevent double taxation, which is a common issue for corporations. From a legal perspective, the limited liability company still provides liability protection. This means that if the business faces financial trouble, creditors can only pursue the limited liability company's assets, not the owner's personal property. However, it is vital to understand the tax treatment to avoid mistakes. One common error is misunderstanding how the limited liability company is taxed. Many owners mistakenly think their limited liability company is taxed as a separate entity. In reality, the owner must report business income and expenses on their personal tax return. Failing to do this can lead to penalties or audits from the Internal Revenue Service. Another mistake involves confusing legal and tax status. The disregarded entity status only applies to federal income tax. At the state level, the limited liability company is usually treated as a separate entity. Owners must comply with state tax filings and other obligations. Neglecting these can lead to issues down the line. Additionally, owners should be aware of self-employment tax obligations. Since the limited liability company's income is treated as personal income, the owner is responsible for self-employment taxes on all profits. Some owners overlook this and end up underpaying taxes, which can create liabilities. Maintaining liability protection is also critical. Even though the limited liability company is a disregarded entity for tax purposes, it must be properly maintained as a separate legal entity. This includes keeping separate bank accounts and proper documentation. Mixing personal and business affairs can lead to losing that liability protection. Lastly, even as a disregarded entity, the limited liability company must have a registered agent and comply with state filing requirements. Failure to maintain good standing can jeopardize legal protections and disrupt operations. In practical terms, the disregarded entity classification simplifies tax filing while retaining the legal benefits of a limited liability company. However, owners must be diligent in meeting all state-level obligations, reporting income correctly, paying self-employment taxes, and maintaining the limited liability company's formalities to avoid common legal errors.